Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. Today we are going to be looking at stock market crashes and market bubbles. We can cover three major ideas in this video. Number one, the principle of social proof. Number two, when to be fearful and when to be greedy. Number three, the life cycle of a bubble. So let's get into the major idea, the principle of social proof. Let's start off with Robert Cialdini's principle of social proof. Social proof is the psychological and social phenomenon wherein people copy the actions of others in an attempt to undertake behavior in a given situation. This was first coined by Robert Cialdini, who wrote a book called Influence, the Psychology of Persuasion. So, for example, when we feel uncertain, we all tend to look to others for answers on how we should behave, what we should think, and what we should do. It occurs as a result of our natural desire to behave in a correct manner and fit in with others. It can be easy to assume that everyone else has a better grasp of what to do in a given situation. Social proof is especially prevalent in ambiguous or unfamiliar conditions or in big groups. Quote by Warren Buffett summarizes perfectly this concept of social proof. The 5 most dangerous words in business are, "Everybody else is doing it." Warren Buffett. Now, coming on to the second major idea, when to be fearful and when to be greedy. So in the last idea, we were talking about human instincts. And human instinct can be any behavior that is instinctive if it is performed without being based upon prior experience or knowledge. And the key 2 words here are without and knowledge. So when we're talking about how the markets move in the short term, we have to understand fear and greed cycles. Warren Buffett, in his 1986 letter to Berkshire Hathaway shareholders, wrote that occasional outbreaks of those 2 super contagious diseases, fear and greed, will forever occur in an investment community. Investors want to make profits quickly, and bull markets provide a great opportunity to make profits in a short period of time. When prices keep rising, more and more people invest more and more money into stocks. Most people want to get rich as quickly as possible, and bull markets invite us to try it. The internet boom in the late 1990s, the so-called dot-com bubble, is a perfect example. Mr. Market is that person that would be giving you those clues to be an instinct-based trader. Since most investors base their investing on emotions and instinct, they follow the mindset of Mr. Market, and remember, instinct is without knowledge, so the solution to this is that we've got to become knowledgeable. We've got to base our decisions on facts as opposed to emotions. So if Mr. Market yells at people saying, "I'm making money," you can make money too, just like your neighbor and his grandma. That's your greed cycle. The mindset during the greed cycle is that a quick buck can be made and that it's going to take very little effort on your part in order to make some money. In greed cycles, people are chasing prices, not value. The mindset here being, I can make a quick buck just like others. So what you have traders who get in for one day and then they make 10% on a stock and then they quickly sell it and they think, oh, I'm going to throw it into another one, and they make some more money on that next thing, and they're day trading and they're doing this consistently day in and day out and they're making some money doing it. Then what happens is the market corrects because you have value-based traders who actually know what the value of those assets are and they start trading them down because they're too high. And then what comes is a fear cycle. In fear cycles, people are scared that they'll lose everything. The mindset here is, I don't know what the value of these stocks is, so I don't want to invest. When people lose an enormous sum of money, most people get very scared, and then the mindset shifts from making a quick buck. The third idea is to understand is the life cycle of the bubble. The economist Hyun P. Minsky wrote a book called Stabilizing an Unstable Economy. In this book, Minsky was one of the first economists to explain the development of the financial instability and its interaction with the economy. Minsky identified 5 stages in a typical credit cycle: displacement, boom, euphoria, profit-taking, and panic. Although there are various interpretations of the cycle, the general pattern of the bubble activity remains fairly consistent. Let's go over each of these 5. Number 1, displacement. A displacement occurs when investors get fascinated with a new paradigm, such as a cutting-edge new technology or historically low interest rates. Number 2, boom. At first, prices climb steadily. During this time, the asset in issue receives a lot of media attention. Fear of missing out on a once-in-a-lifetime chance encourages additional speculation, attracting a growing number of investors and traders. Number 3, euphoria. During this stage, caution is cast aside as asset prices surge. During this phase, valuations reach extreme levels as new valuation methods and criteria are pushed to support the unrelenting ascent. Number 4, profit-taking. At this time, the smart money begins to sell positions and take gains, heeding the warning indications that the bubble is going to collapse. Number 5, panic. It just takes a tiny occurrence to puncture a bubble, but once pricked, the bubble is unable to reinflate. During the panic stage, asset values reverse course and fall at the same rate as they rose. So which period of the life cycle do you think we're in now? Let me know in the comments down below. Thank you so much for watching, and if you like this video, please share it with your friends and family. It'll really help this channel a lot. Leave your comments in the section below, and let me know your thoughts about this video and what I should cover next.